I'm on. I used the link in the, so make sure it's right. I think it's connected.
I think maybe when you turn the camera on or something.
Huh?
Maybe when I turn the camera on or something.
No, it's on. I'm seeing myself over here. Okay, you see me?
Is your camera and your microphone on?
Yeah. Try it again. So for 4 minutes and 5 seconds in recording. You talk.
Yeah.
Okay, here we go. So just share.
Okay, now I can see it.
So I can hear your computer. You can mute.
Okay.
Yeah. Okay. Am I centered in the screen?
I don't see your face right now. I just see
Okay.
your screen.
Hello, everyone. As well. Hi, it's Greg Ritchie, Citizens Financial. Hopefully, you guys are having a wonderful day. The weather in Northern California is absolutely amazing. It's beautiful, not too hot, and just what a great start of spring. I want to give everybody about it's 12 o'clock, maybe 2 to 3 minutes to log in. I want to kind of hold myself accountable and make sure that I don't consume your precious time during this lunch. Maybe just 15 minutes total, with about a 2-minute waiting, just kind of give you an opportunity to hop in and get on board. So look forward to briefly going over this, hopefully not too fast, but I think it's pretty exciting. Our DP program, they really help homeowners, and as an agent or a more professional, really assist your clients to go in the spring buying season with an exceptional product that gives them equity from day one. And I'll kind of touch on that a little bit more. But to give about maybe 2 more minutes to log in, and we'll get started. Okay, let's give everybody about 1 more minute. We'll start at 12:03 and get this presentation going. Already started. All right, everybody, hope all's well. It is 12:03. I want to hold true to my word and get this presentation started. First and foremost, thanks so much for giving us an opportunity to talk to you guys today. I know your time is precious, and I don't want you to utilize as little time as possible, so therefore you can kind of get that time back to yourself, your clients, and your lunch break. Our DV program is really amazing, especially it is going to the home buying season. It's very unique spring home buying season. We are not seeing the massive amount of inventory that typically follows a traditional real estate cycle, where we have a lot of homes come onto the market in the spring buying season. We're seeing some phenomenons. A lot are due to the kind of the rate lock, right? We have people that have 2%, 3%, 30 fixes, and they are hesitant to put their house in the market, to buy into this market at a higher cost of ownership because of the rates. So it's creating a little bit of phenomenon right now. So we'll see how our inventory goes and kind of cities and counties throughout California as we talk daily to people in Southern California. We have an office in Long Beach, loan officers in West Los Angeles, Santa Monica, Upland, and so we have a good pulse on kind of where things are throughout California. And so whatever market you're in, you might not be alone. It is very interesting what's going on throughout California. Okay, so our DB program, it's timely. It's absolutely amazing. It's on the cusp. We've been providing this for quite a while. The CalHAPA Dream program came out and it went away. Now it's supposedly going to come back. Ours is the alternative to that. The difference is we're not doing equity sharing. We are providing an exceptional product that gives you ownership of your property with equity. It's a difference. You buy a house at $700,000, you qualify for $500,000 with the CalHAPA Dream program. That $200,000 they give you, it might take you a decade to pay that back. So you'll pay that house for probably 10 years, 7 years without earning an ounce of equity because it's their equity, it's not yours. You do have the mortgage interest deduction, SALT, state and local tax deduction, as a write-off. So there's a benefit of homeownership, but it's more of the tax base. Let's say that you refinance one time to lower your rate. That's great. The cost of that debt is cheaper, but you don't own any equity. That's a problem. Let's say you stay in the property for a decade and now you're actually square zero. No equity. They have theirs. They stay a part of that loan if you have the original loan, that 20% increase on top of that. Most likely you refinance at that point. So maybe after year 7, 8, 9, you might start earning equity for yourself. Our program, on the other hand, is very different. Let's jump right into it. Okay, our down payment program is eligible for residents throughout California. This program could enable you to purchase a home valued up to $1 million. Now, it's based on the FHA loan limit per the county. I'm not motivating, condoning, pushing my clients to buy a $1 million house with DPA. I think really you should go into this market not asking what is the maximum pre-approved for. You need to let us know what are you comfortable paying. They would align the price of the home and the mortgage product with that. I don't want you to get over your head. We're able to qualify clients with some pretty high ratios, and that's gross income, not net income. And that's excluding all the off-balance sheet expenses. So please make sure when you get pre-qualified by our company or anybody, you have made very clear your goal and desire of what your payment is and align that with your maximum eligibility and see the difference of that gap of what you're comfortable paying and what you're quote unquote qualified to make a payment. Two very different numbers. Our DPA has a second mortgage. It is fully forgiven. After your sixth payment on the first mortgage, the actual DPA is given to you as a grant funds as a lien. There are no payments due. It is a silent lien on title. After 6 payments, it's forgiven. Our program allows for 100% of the closing costs to be covered by the seller or the home builder of choice. That's huge. Okay, eligibility. This gets a little fun. To be eligible for the program, the borrower must meet only one of the following categories outlined to qualify. So, main category, like 95% of the people that will utilize this program, stop right here. First time home buyer. Fannie Mae, Freddie Mac is not a state, local guideline. It's a federal guideline across all of America. You're a first home buyer if you have not bought a house in the last 3 years or if you've never owned a house. Very cool. You could have owned a house for some reason, sold a house, had a foreclosure, short sale, and it's been over 3 years and you need to get back in the market. You can as a first home buyer again. If you're currently retired employment or volunteered, non-paid member of certain job types, you qualify regardless. The last two bullet points, those are a little more kind of default redundant with a lot of the DB programs out there. 100% of the AMI stands for Area Median Index. So depending on what county you're in, you take the Area Median Index 100% and go 40% above that, 140%. If your income's higher than that, then you can't use this program. But if you're first a home buyer, that's a moot point. Underserved census tracts, if you don't qualify for either of the top three, but you're in an underserved census tract, you can qualify. But majority of people are first home buyers, so all those other bullet points are a moot point. All right, here's the one. Any borrower on a loan application that is current, retired, voluntary, non-paid employee will qualify. It's awesome. See below profiles. So military. First bullet point, does that really make sense? You're like, I think there's VA financing for military. There is. But we've done enough financing and understand the business well enough to realize there's a lot of veterans that have had life experiences, some positive, negative. Maybe they had a short sale foreclosure that tied up some of their entitlement of their VA benefits. So therefore, in order to regain their full benefits, you get 100% financing, they have to pay back the VA a sum of money. A lot of times, it's a large sum of money. It might be $40 to $60 to $80,000 to reattain 100% eligibility of their entitlements. So for those military personnel, it makes more sense for them to use an alternative 100% financing product like ours. If you're a first responder, police officer, firefighter, public safety member, etc., you qualify. Educators, we have the teachers program. It's very popular before, but what about everyone else who works at schools? This program kind of alleviates that. If you're in education, you can be the principal or the janitor. You qualify. Doctor loans, that was so popular. Now, from a doctor to a janitor, if you work at a medical facility, you qualify. Now let's expand that. The medical facility is not just a hospital. It can be a care center. You can also run a private practice daycare and qualify. It's amazing. Civil servants in federal, state, and local municipalities, pretty awesome. We're here back in California. We're by the amazing Air Force Base, Travis Air Force Base, the largest bases in the Western United States. There is a huge amount of civil servants that walk through those gates every day to keep our nation safe. They are not enlisted. They're not, Air Force enlisted personnel, but they work for the United States government as a civilian servant. They will qualify. They don't have VA benefits. They don't qualify as an enlisted personnel, but they serve this country. So as a civil servant, they qualify with our products. Here's an example, $600,000 purchase price. Traditional FHA. I want to keep kind of apples to apples. Purchase price $600,000. 3.5% down payment on that is $21,000. So closing costs. In this hypothetical, let's get the lowest rate possible. We're going to, lowest rate, you pay title fees, escrow fees, all the closing costs. It's $25,106.30, this hypothetical. So you have down payment, you have closing costs, and together you're $46,000 in change to buy that house. A lot. With our product, this is where the combination of our DPA program and really making sure you align yourself with an exceptional realtor to really help guide you through the process of negotiating and creating that win-win scenario. I help with this process as far as educating the sellers, educating the realtors of how to really bring that value. But a lot of realtors, they understand and they help right away. Down payment's the same, 3.5%, 21,000. Typically 100% of the funds required are covered. So 3.5% is 100% of the down payment. DPA program covers that. Closing costs, same closing costs, $25,000 and change. This is where you want to create that win-win scenario. By a new home builder, you request a home builder to give you a seller closing cost credit to cover the cost at closing. If it is an existing home, you create a scenario when you ask for a seller closing cost credit, they cover up to 100% of the closing costs. You do this by two things. Just initially asking for credit to cover the closing costs, or you could take the price, the net sheet price the client who's a seller wants. You can increase that purchase price, then ask for that same amount back as a seller closing cost credit. As long as the house will appraise and comp at that higher price, in this scenario, it would be $625. You would receive that $25,000 as a seller closing cost credit. You would walk in this house with essentially zero out of closing. Now, I did not account for that zero out of closing for two items. You have the appraisal, typically it's about $750, paid by credit card, and a voluntary home inspection. Please do a home inspection, make sure the house is amazing. That costs probably $350 to $1,000, depending on where you are, California, and the complexity of what you're asking for. You can buy the house with the right financing, the right negotiating team at minimal cash out of pocket. All right, eligible programs, pretty cool. It's all FHA. The programs apply to FHA only, but it's not just FHA, it's FHA traditional, limited, it's standard. So what does that mean for you? You can work, get pre-approved with our company, align yourself with an exceptional realtor, find that house in the marketplace that maybe people are passing over because it needs a little TLC, needs a little care. And it's really expensive to buy a house to turn around and spend another $20, $30, $40, $50,000 into that home to really make it the way you and your family would love. This product allows you to look at the house, look at the current valuation of it, look at the future market value, and as long as you can work with a contractor, write a bid, cost secure, say $25,000, $30,000, as long as the future value of that home is in line with the FHA 203K program, you're good to go. You can submit the offer with the contract. They will fund your purchase 100% of the total cost to buy the house. So let's say you buy a house at find a house at $500,000. It needs about $50,000 worth of work. Or, oh boy, the future value of the house is $575 if you were to repair it. So $575 is less than $550, taking the purchase price $500 plus the $50,000 of the cost secure. You present both of those. You will fund the transaction 100% financing the DPA product on the cumulative of the purchase price plus financing in the construction. You close, they start the repairs in the house, and congratulations, they have the home of your dreams the way you want it with the down payment covered by our program. It's pretty amazing. Parameters. Okay, 620. Our FICO score is actually lower than others, makes it easier for the barrier to entry. 30-year fixed is a purchase product only. It's not a cash out, it's not a refinance. This is for intent to occupy purchase only. Now, the maximum DTI is 48.99. That's high. So really, I'm not finding any problems with that. I know a few programs out there at 50%. That little difference is not really making a difference. The property types, it's 1 to 2 units only. This product is made to help people get into home ownership, not become the next multi-unit burr flipping master of the universe. But it's a 2-unit. So what does that mean? That means you can buy a house. It's a 2-unit live in one unit, rent the other unit out from day one, and become a investor at the first ownership. You live in one unit, you rent the other one out. That unit helps pay for your mortgage, and you're starting out your home owning experience as a real estate investor. Pretty amazing. The manufactured housing, single wide, multi wide condo projects, yes. When it comes to manufactured housing, the caveat is we need to make sure the land below the property is owned. It cannot be a lease, and it needs to be on a permanent low-rise foundation. You meet those two guidelines, and most likely you can buy the manufactured housing through a DPA program. Condo projects need to be approved. So if they're not, let's work on getting the condo project approved on the list. Okay, I am 1 minute over, so I hope everyone found value in this. I know I went fast. It's an amazing program. It's an amazing guideline. Takeaway is this program will give you or your clients, from the moment you close, you have 3.5% of the purchase price as equity. That's amazing. It's better to have $25,000 of equity from day one and have maybe a smaller house, our program, than using the CalHFA Dream program, and you're now in debt, in ownership with the government, because 20% of the purchase price is really their money. So guys, it might take a long time to pay back that lien of $200,000 on a $7,000 purchase price if you qualify for $500,000 loan amount. With us, you have more equity in 6 months than you would with that program in over a decade. So think about it. You need to weigh your options. Maybe buy that bigger house, not the right decision. You should buy what you can afford. I look forward to helping you, and have a wonderful day, everybody.